Hey everyone, I'm Bradford with the Penny Pinterest Guide of Personal Finance. In this video, we're going to break down the differences between a Roth IRA and a traditional IRA to help you figure out which one's going to be the best fit for your finances. While both are IRAs or individual retirement accounts, they have way more differences than they do have similarities. So starting out, what they do have in common is they both have the same contribution limits as well as the same rules for when you are allowed to start withdrawing your money. Now, as of 2022, the annual contribution limits are going to be $6,000 a year if you're younger than 50, but if you're age 50 or older, you're allowed catch-up contributions, which bring your total annual contribution amount to $7,000. And the second similarity is going to be that you both have to be 59 and a half or older before you're allowed to start withdrawing penalty-free from both your traditional and your Roth IRA. But that's where the similarities stop. So let's jump into the traditional IRA and walk through how it actually works and where the differences are going to be. So a traditional IRA gives you a tax-deferred benefit, which means that in the year that you make your contribution, it's actually going to lower your taxable income by that amount. So say you make $100,000 a year and you contribute your maximum amount of $6,000, assuming you're age 30, that's going to take your taxable income from $100,000 down to $94,000. And then the money that you contributed into your traditional IRA is going to grow tax-free until you start making withdrawals, and then you'll begin paying taxes on all of that money at that point. Now, with a traditional IRA, there are quite a few rules concerning how you're actually going to get access to your money, and then additional rules on what you have to do once you start accessing it. So, as I previously mentioned, age 59 and a half is how old you have to be before you can start withdrawing your money without penalties. But if you decide you need, for whatever reason, to access your money before that age threshold, not only are you going to have to pay any taxes on any money that you withdraw immediately, but you're additionally going to be hit with an additional 10% fine above and beyond any taxes that you're required to pay on those withdrawals. Now, there are a few exceptions, and those are going to be listed on the IRS's website, where you're not going to be subject to that additional 10% penalty for withdrawing your money before age 59 and a half, and you can see them listed, and I've also listed a link down below to that specific table. Now, another major stipulation that applies to a traditional IRA is going to be the required minimum distributions that take effect beginning at age 70 and one half. So a required minimum distribution means that you are required to pull money out, at least with a certain amount. And those are going to be, again, based on IRS tax tables that I've listed in the description down below. But the nuts and bolts of the matter is that if you don't begin withdrawing money at age 70 and a half, you're going to be assessed a fine of 50% of whatever the withdrawal amount was supposed to be. And over time, the required minimum withdrawals are going to increase and increase year on year. And eventually, if you live long enough, it's going to get to the point where it forces you to have withdrawn all of the money that was in your traditional IRA. So for a traditional IRA, the important numbers to remember when it comes to age are going to be 59 and a half, which is when you are allowed to start withdrawing without any penalties, and then age 70 and a half, where you are forced to begin withdrawing money, or else they're going to hit you with that hefty 50% fine, which, if you allowed that to happen, would really suck. Now, shifting gears, let's talk about the Roth IRA, which was actually created several decades after the traditional IRA was introduced and eliminates many of the drawbacks that the traditional IRA is subject to. While the traditional IRA defers your taxes, with the Roth IRA, you still have to pay taxes on any contributions that you make in the same year that you make them. So they're going to be taxed like any other income that you make. At first glance, it might seem like that is actually a negative because you're not getting the immediate tax savings that a traditional IRA offers. But here's where the really important thing is once you pay those initial taxes on the contributions that you make into your Roth IRA, you will never pay taxes on that money ever again. So that means it's able to grow tax-free. And when you make those withdrawals, when you decide you want to start making those withdrawals at age 59 and a half to avoid any penalties, none of that money will ever be taxed again. And with the power of compound interest behind you, that means you're going to actually have significantly more money that is due to capital gains than any of the money that you've ever contributed. So when you look nuts and bolts at a Roth IRA versus a traditional IRA, the tax savings could literally be a multi-million-dollar difference. Now, when it comes to withdrawing money with a Roth IRA, you're still going to have that 10% penalty if you decide to withdraw your money prior to age 59 and a half. But it actually doesn't apply to all of the money that's in your Roth IRA. You're actually able to withdraw your contributions that you've made at any point without any sort of penalty since you've already paid taxes on them. But the only part where you'd actually be hit with that 10% penalty is if you withdraw any of the gains that you've made. So say you've contributed $25,000, but you've also made $25,000 in capital gains, you're going to be able to withdraw $25,000 of your contributions without any sort of penalty, so long as you don't withdraw above the $25,000 that you've actually contributed, if that makes sense. Now, word of caution, I would never actually recommend withdrawing any of your money out of your Roth IRA unless you're facing bankruptcy. The reason for this is because once you pull that money back out, you're not able to put it back in. So you've lost on the ability of all of that money to be able to grow tax-free because you've pulled it out for whatever reason that you have. Now, with all those benefits, you're probably asking yourself, what's the catch? Really, the only snag when it comes to the Roth IRA is that you can actually earn too much money and you make yourself ineligible to actually contribute to Roth IRA. Now, as of 2022, those contribution limits are again going to be listed on the IRS's website. So if you're single, filing by yourself, you're basically going to cap out at $144,000. And if you're married filing jointly, that cap is going to be at $214,000. Now, even with all of that being said, you're actually able to still contribute to a Roth through what is known as a backdoor Roth if you make above those income thresholds, but the actual how-to on how to do that is pretty complicated, so I'll leave the explanation to your tax professional. Now, when it comes down to the brass tacks, what is going to be a better option for you as an investment vehicle, a Roth IRA or a traditional IRA? Now, in almost all circumstances, I would say a Roth IRA is going to be the better choice. Now, the thinking behind that is because right now, as you're younger, hopefully you're going to continue to increase your earning potential over time, which means that right now you're going to be in a lower tax bracket than what you would potentially be in the future. So you would want to pay taxes right now, which is what a Roth IRA would do while you're in that lower tax bracket, and then be able to withdraw the money tax-free in the future as you're older when you would be in a potentially higher tax bracket. Now, a traditional IRA, on the other hand, would really only make sense is if you're in a higher tax bracket right now and you know in the future you're going to be in a lower tax bracket. So really the only situation that I can see this applying is say you're a C-suite executive, you're making 7 figures with a W-2 job right now, and you know in the future, once that paycheck goes away, you'll be in a lower tax bracket. But even then, in that situation, a $6,000 tax savings really isn't going to move the needle much, and you're going to be focused on much bigger ideas on how to save money, like the videos that I break down in this video. I want to thank you for watching today. I hope you got some benefits on whether a Roth or a traditional IRA is going to be better for you. And please remember, from your first penny to your first million, we're here to help.